What if I told you the Federal Reserve just flipped a switch quietly, without a press conference, and that one move could drain the value of your savings in Miami, shrink your paycheck in Dallas, and inflate your rent faster than Phoenix summer heat? Because just days ago, the Fed stopped removing money from the financial system. And every single time in U.S. history, the Federal Reserve stops shrinking the money supply, it's because they're preparing to expand it again. And every time they expand it, regular Americans pay the price, usually before they even finish their morning coffee. Why does a grocery trip in Seattle cost what a car payment used to? How is inflation officially under control while California families can't control their monthly bills? Why does your 401k look like a roller coaster at Six Flags? If you feel like your money is melting, it's because it is. And the reset isn't coming. It has already started. Let's start with a moment almost nobody noticed because, honestly, the Fed didn't exactly shout it from the rooftops. A few days ago, the Federal Reserve quietly stopped draining money from the financial system. They didn't call it a big pivot. They didn't hold an emergency press conference. They simply ended quantitative tightening, the process where money slowly disappears from the financial system like steam leaking from an old pipe. And anytime the Fed stops shrinking, it's because they're looking for room to grow, meaning money is about to start flowing again, whether openly or through the side door. Now, why does this matter to your life in places like Cleveland, Phoenix, Austin, or Tampa? Because the Fed's balance sheet is like America's financial weather system. When it shrinks, conditions tighten, markets cool, mortgages freeze, and businesses hesitate. But when it stops shrinking, the clouds part, liquidity returns, and asset prices begin creeping upward again. It's no accident that Wall Street watches the Fed's balance sheet like Miami watches hurricane season. A shift, even a small one, changes everything. And here's the part that stings. When liquidity rises, assets inflate, not salaries. Every single time. So homeowners in Denver or investors in New York might see a boost, but wage-based households in Columbus or San Antonio, they get left holding the bill. Because when more dollars chase the same number of goods, prices go up, even if the government reassures you that inflation is cooling. It's cooling the same way your house cooling down, meaning it went from burning to slightly less on fire. This is the same playbook we've seen for decades. Look back at the 1971 Nixon shock, when the dollar was cut loose from gold, or the 1980s. Volcker pivot, or the 2020 pandemic liquidity tsunami, when stimulus checks landed in mailboxes from Los Angeles to Boston, while the Fed quietly bought trillions in bonds. What followed? Stocks doubled. Home prices jumped 30 to 40%. Crypto went to the moon, then back, then halfway again. And while asset owners were celebrating, families in Arizona and Georgia were watching grocery receipts rise faster than their hourly wage. So what makes this moment different? 2 words: unemployment pressure. The job market is softening in states like Michigan, Pennsylvania, Washington, and even parts of Texas. Layoffs in tech hubs like Seattle, Austin, and San Jose are creeping higher. And when the labor market weakens, the Fed gets nervous because a strong labor market is their favorite excuse to hold interest rates higher. But what about the second unemployment rises? Suddenly, inflation looks manageable, and rate cuts start sounding like responsible policy. Markets are betting on a possible rate cut, or, at the very least, extremely dovish language that hints at easier money ahead. And here's the not-so-funny irony. The Fed spent nearly 2 years telling you inflation was the enemy, but the moment recession risk creeps in, they'll gladly choose inflation over a hard downturn. In other words, they want prices high, just not too high. Just high enough to slowly erode the nation's debt and your savings. Let's put this into real human terms. Picture a couple in Atlanta trying to buy their first home. Imagine a single mom in Chicago trying to stretch her paycheck. Picture a retiree in Tampa watching fixed income barely keep up with rent. When the Fed injects liquidity back into the system, asset values rise far faster than wages. Your home becomes more expensive. Your groceries become more expensive. Your car loan becomes more expensive. But somehow, your paycheck stays the same size, like it didn't get the memo. That's not an accident. It's structural. When the Fed pumps liquidity into the system, that money doesn't rain down evenly like a generous thunderstorm. It flows through Wall Street first, through JP Morgan, through Bank of America, through the bond desks and credit markets, before trickling into the real economy like a leaky faucet. By the time the new money reaches normal households in Kansas City, Portland, or Raleigh, inflation has already absorbed most of the benefit. But asset owners, they've already captured the upside. And this brings us to the part that's hardest for Americans to accept. The system isn't broken. This is the system. It's designed to support asset stability first, consumer affordability second. Because Washington, Wall Street, and even the Fed believe rising asset prices equal a healthy economy, even when half the country can't afford a starter home. And that's why, from Silicon Valley to South Florida, the American middle class feels like it's running on a treadmill that someone keeps turning up a notch every few months. But this is where the reset begins. The Fed paused QT. Unemployment is rising, the economy is slowing, and interest rate pressure is building. The U.S. government needs cheaper borrowing costs. The markets want more liquidity, and the Fed needs to avoid a hard landing, especially going into a politically sensitive year. So, they chose the predictable option: prepare for more money. That's the beginning of a new cycle, one that rewards assets and erodes cash. The quiet reset isn't a future event. It's happening right now. The Federal Reserve isn't just a building in Washington. It's a personality. And the personality at the top, the Fed chair, often matters more than any policy statement or press briefing. One shift in leadership can change how markets behave from Wall Street to Wichita, from Silicon Valley to South Carolina. And right now, the conversation around who might replace Jerome Powell is starting to send shockwaves through economic circles. Because the frontrunners are not the usual, safe, predictable academic candidates. They're louder, more market-aware, and in some cases, openly pro-crypto, which, depending on who you ask, is either the future of finance or the world's most well-designed slot machine. One of the potential candidates gathering attention, especially in betting markets, is Kevin Hassett. The man has a resume that blends economics, politics, and a not-so-subtle affection for cryptocurrency. He's connected to Coinbase. He's openly supportive of digital asset innovation. And he's been vocal about the need for growth-focused economic policy. Whether he ultimately gets the chair or not, the fact that he's in the discussion tells you everything. Washington is warming to digital money. And the next chapter of U.S. monetary strategy may look very different. Even the Fed, not famous for being early adopters, can only ignore the future for so long. Now imagine putting someone like that in charge of America's most powerful financial institution. A Fed chair who sees stablecoins and digital asset rails not as threats, but as tools. That would fundamentally reshape how liquidity flows through the economy. Instead of slow, clunky monetary operations, you might see instant digital liquidity injections, new forms of treasury settlement, and a more programmable dollar. The kind of dollar that moves fast, tracks everything, and doesn't need a printing press. Just a software update. Good for efficiency. Convenient for the Fed. Slightly terrifying for anyone who still values privacy more than a 5-second transaction time. And here's the part that connects directly to your wallet. A growth-oriented Fed chair almost always means easier money. Lower interest rates. More credit. More liquidity. More support for markets. And when the Fed starts loosening, stocks, real estate, and speculative assets tend to run. Ask anyone who bought a home in Austin, Miami, or Las Vegas in 2020. They watched valuations jump so fast, it felt like Zillow was malfunctioning. Whenever the Fed signals softness, the market hears opportunity. And when markets hear opportunity, everyday Americans eventually hear, why is everything around me suddenly more expensive? The December Fed meeting is where the first domino may fall. markets are pricing in a strong chance that Powell will hint at rate cuts, even if he doesn't deliver one immediately. And here's the ironic twist. The Fed will justify softening with rising unemployment. Layoffs in Seattle's tech sector slowed down in Detroit's manufacturing belt. Softness in hospitality jobs across Orlando, Vegas, and New Orleans. All of it adds pressure. And the moment unemployment rises, the Fed's appetite for higher rates mysteriously evaporates. They'll talk about stability, soft landing, and economic resilience, which in normal English means we're easing up. But here's where the story gets interesting. When the Fed cuts rates while also ending QT, they're essentially opening two floodgates at once. Banks like JP Morgan, Wells Fargo, and Citi suddenly have cheaper access to capital. Corporations can refinance debt at lower cost. Consumers see mortgages, auto loans, and credit card APRs start to slide, at least in theory. But structurally, easier money means more borrowing, more leverage, more spending, and asset inflation. So who wins in this new era? The same groups who always win when liquidity returns. Asset owners, real estate investors, equity holders, people with diversified portfolios, anyone holding stocks in a 401k in Denver, or owning multifamily property in Charlotte, or holding tech shares in San Francisco. These folks benefit as markets climb on new liquidity waves. But wage earners who hold most of their net worth in cash, they face a slow-motion drain. Because with easier money comes inflation, and with inflation comes the slow erosion of purchasing power. It's not theft, it just feels like it. And who loses? People holding long-term bonds. Fixed-income retirees without inflation hedges. Wage earners whose salaries lag behind price increases. Families renting in cities like Los Angeles or New York, where landlords adjust prices faster than the Fed can publish meeting minutes. Even savers in high-cost cities like Honolulu or Boston quickly learn inflation doesn't care how hard they work. It only cares how much liquidity the Fed allows into the system. The broader point is this. If the next Fed chair is someone more comfortable with digital finance, more supportive of economic stimulus, and more open to liquidity expansion, then we are entering an era defined by more intervention, not less. Money will move faster. Markets will react faster. Inflation will rise faster than wages. Then, wages again. And the American middle class will face the same question it faced in 2008, 2020. And now, are you positioned on the side that benefits from liquidity or the side that pays for it? Because the uncomfortable truth is this. The United States doesn't escape its debt problem through discipline. It escapes it through dilution. And dilution always rewards owners of assets and punishes holders of dollars. Whether Kevin Hassett or someone like him gets the role, the direction is clear. The future of us money is going digital, going faster, and going straight into the pockets of asset holders long before it reaches workers. And that's why understanding this shift isn't optional, it's survival. When people hear money printing, they imagine an old machine spitting out fresh $100 bills somewhere in a basement under Washington. But that isn't how it works anymore. The modern version is much cleaner. No ink, no paper, just numbers changing inside computers. And the moment the Fed stopped shrinking its balance sheet, it opened the first door in a chain reaction that eventually reaches your grocery bill in Chicago, your rent in Phoenix, and your future mortgage rate in Orlando. The process is simple on the surface, but extremely powerful underneath. The first step is the Fed allowing its balance sheet to stabilize. During quantitative tightening, the Fed lets old bonds expire without replacing them. That quietly destroys money. But when QT stops, the destruction stops. Suddenly, the banking system isn't losing liquidity every month, it's holding steady. And in financial terms, holding steady is the first hint that the Fed is preparing to go in the opposite direction, like a car that stops braking before it accelerates. Once the Fed stabilizes the balance sheet, the next step is reinvesting maturing assets. Instead of letting old mortgage bonds disappear, The Fed buys new Treasury bonds with the proceeds. This creates consistency in the bank reserve system. Banks, especially mega banks like JP Morgan or Wells Fargo, watch these reserves closely. More reserves mean more lending capacity. More lending capacity means more credit flowing into the real world. It's like giving a firefighter more hoses. You're signaling that more water, or in this case, more money, is about to move. Now here's where it becomes unavoidable. When the Fed adds reserves, banks don't just sit on that cash. They lend. And thanks to how fractional reserve banking works, $1 of reserves can support many dollars of loans. $1,000 of fresh liquidity inside the system can become tens of thousands once it's cycled through business lending, mortgages, auto loans, and corporate credit lines. If you've ever wondered how money seems to multiply out of nowhere in places like Dallas, Atlanta, or Minneapolis, it's because banks aren't just lenders, they're amplifiers. But amplification comes with a catch. When banks lend more, consumers borrow more. And when consumers borrow more, spending rises. And when spending rises faster than supply, prices go up. Not immediately, not obviously, but steadily, like someone turning up the thermostat in your house 1 degree at a time until suddenly you're sweating. Inflation is rarely explosive, it's incremental. For Australian dollars, gallon of milk becomes $4.49. 1,900 Australian dollars rent becomes $2,150. 325 Australian dollars. Car payment becomes $395. Quiet increases, but relentless. This is why every liquidity cycle always feels the same. The wealthy, who own more assets, benefit first. The stock market rises. Real estate prices strengthen. Crypto gets more attention. Meanwhile, actual wages in places like Memphis, Albuquerque, or Pittsburgh barely move at all. The gap widens. Not because people work less or try less, but because the system rewards ownership far more than effort. It always has. The Fed pumps liquidity into the pipelines at the top, and gravity decides where the money pools. The deeper issue is that inflation doesn't hit everyone equally. High-cost cities like San Francisco, Boston, and New York feel the pressure instantly because demand is already elevated. Mid-tier cities like Jacksonville, Columbus, or Salt Lake City feel it a bit later, but with sharper pain because incomes don't rise as fast. And rural towns, they feel it too, only differently. Fewer housing options, fewer employers, but the same rising prices. Inflation doesn't care about your zip code. It only cares about how much liquidity is sloshing around in the system. Now let's talk about the part nobody enjoys hearing. This reset we're entering isn't a glitch. It's intentional. The U.S. has over $34 trillion in national debt, and inflation is the only politically acceptable way to reduce the real burden of that debt over time. Defaulting would be catastrophic. Cutting spending is political suicide. Raising taxes enough to pay off the debt is mathematically impossible. So what's left? Dilute the dollar slowly. Inflate the problem away. It's the same method used after World War II and the 1970s. And it works, just not for ordinary households. As this liquidity funnel opens, asset markets begin inflating again. Homeowners in Denver and Atlanta see property values rise. Investors in Nashville see their portfolios recover. Business owners in Houston find credit easier to access. But renters in Los Angeles, young families in Orlando, and retirees in Phoenix feel the squeeze. They see the inflation first, not the asset gains. Their cost of living climbs while their purchasing power quietly erodes. It's a wealth transfer, not loud, not obvious, but absolutely intentional. And here's where the Fed's subtlety becomes almost darkly comedic. They will describe this inflationary cycle as orderly, manageable, or within target ranges. They'll say wage growth is healthy even when it trails inflation by 2 full percentage points. They'll say consumer spending is resilient, when, in reality, the average American is using more credit card debt than any time in history. The official narrative is polished. The lived experience is painful. But this system isn't random. It's a machine. Money flows from the Fed to banks, to markets, to corporations, and finally to consumers. But by the time the average American in Omaha, Raleigh, or Fresno feels the impact, most of the benefits have already been absorbed by financial institutions and asset holders. The leftovers come in the form of wage increases that barely cover rising rent or medical bills. The winners always win first. The others get the delayed version. And that brings us to a simple, uncomfortable truth. If you're holding mostly cash, inflation is your enemy. Not because you made a bad choice, but because the rules of the system mean cash must lose value when liquidity expands. Meanwhile, the moment you own assets, stocks, real estate, metals, businesses, you move from the losing side of inflation to the benefiting side. Inflation hurts cash holders and helps asset holders. That's not an opinion, it's math. This is the core of the reset. Money is being repositioned. Not dramatically, not suddenly, but continuously. And the people who understand how the flow works, from Wall Street traders in Manhattan to real estate investors in Charlotte, are preparing for the next wave of liquidity, while most Americans are simply bracing for the next wave of price increases. Most people hear the word reset and imagine some dramatic moment, sirens, breaking news, emergency press conferences. But real financial resets don't happen in explosions. They happen in quiet shifts. In headlines no one reads. In Fed statements nobody understands. And in grocery stores where people suddenly ask, why did this get more expensive again? The reset is already here. The question now is simple. Will you be positioned for it or punished by it? The first and most important rule is brutally straightforward. Don't sit in cash. Cash loses value in an inflationary cycle by design. If the Fed is preparing to pump liquidity into the system, and all signs say they are, then inflation will rise faster than the interest you earn in any savings account, even those heavily advertised high-yield ones. People in Chicago, Tampa, or Portland who proudly build large cash stacks in checking accounts get hit first. Your dollars quietly decay every month, and the Fed will never send you an apology card. So what should Americans own during a reset? Historically, assets that inflate with liquidity, stocks, real estate, commodities, and physical metals like gold and silver perform best. Gold in particular has been outperforming nearly every asset class while the Fed prepares its pivot. It's not magic, it's math. When the currency weakens, hard assets strengthen. Real estate in cities like Charlotte, Nashville, and Dallas may also get a temporary boost once borrowing costs fall. And stocks, especially large-cap U.S. companies, tend to thrive when liquidity returns. It doesn't mean buy recklessly. Means position intelligently. But owning assets doesn't just mean owning stocks or buildings. It means owning anything that produces value or income. A small business, a side hustle with pricing power, a rental unit, dividend-paying shares. The American system, for better or worse, rewards ownership far more than effort. A person in Miami with a modest investment portfolio often outpaces the financial progress of someone in Detroit working 2 jobs but owning nothing that appreciates. It's unfair, but it's true. And resisting the reality doesn't protect you from it. The second rule of surviving the reset is minimizing high-interest debt. Credit card debt in America is at record levels, and lenders have absolutely no shame in charging 25 to 30% APR, while inflation runs at 3 to 4%. That's not lending. That's legalized financial draining. And millions of Americans in Phoenix, Atlanta, Philadelphia feel trapped because every month their balances rise faster than they can pay them down. During a reset, these debts become heavier because your money loses value while your debt stays fixed. It's like running a race where someone keeps moving the finish line further away. Next, Americans need an emergency fund, but here's the detail most financial gurus forget. The fund must be inflation adjusted, 3 months of savings in 2018 is not 3 months in 2024, and it will not be 3 months in 2025. If inflation eats away 7 to 10% per year in real-world living costs, your emergency fund has to grow accordingly. A family in Denver or Raleigh that once needed $6,000 set aside may now need $8,000 or more just to survive the same 3-month window. Prepare for reality, not nostalgia. Another overlooked strategy is cutting financial leaks. In this reset, small mistakes cost big money. Subscription traps, unused memberships, contactless impulse spending, buy and pay later, easy payments that lead to late fees and credit devastation. Companies practically engineer their apps and payment systems to take advantage of distracted or overwhelmed consumers. And the truth is, families in New York, Houston, Las Vegas, and Sacramento are losing hundreds a month to things they don't even use. Tightening these leaks is the fastest tax-free raise anyone can get. But here's something equally important. You must review your financial statements. You'd be shocked how many Americans never look at their bank transactions, credit card activity, or insurance renewals. Fraud, price increases, hidden fees, they slip through the cracks when no one is watching. And in an inflationary reset, any company with billing power will happily inch your payments upward, hoping you're too busy or stressed to notice. The system isn't malicious. It's just designed for profit, not protection. One of the most powerful things Americans can do right now is reassess the assets they own or don't own. If you're a homeowner in Kansas City, maybe it's time to build equity faster. If you're a renter in Los Angeles, maybe it's time to look at markets where owning becomes possible. If you're sitting on old collectibles, tools, furniture, electronics, sell them. Turn dead value into financial breathing room. In a reset, liquidity is a shield. But the emotional side matters too. Because for many Americans, from Boston to Baton Rouge, this financial roller coaster feels personal. It feels like you're working harder every year only to fall further behind. Like the system is rearranging itself while you're just trying to pay rent on time. And the truth is, you're not imagining it. The Fed's choices do reshape the economy. Market cycles do widen inequality. Prices do rise faster than wages. And the system does lean heavily toward those who understand it. But here's the part most people never hear. Understanding the system puts you on the winning side of it. The moment you learn how liquidity flows, who benefits first, how inflation works, and how assets respond, you stop being the victim of the reset. You become the person who saw it coming. The person who positioned correctly. The person who doesn't panic when prices rise, because you already own things that rise with them. The reset is not avoidable, but becoming collateral damage is. This next chapter of the American financial system will create two groups: the people who get crushed by rising prices, and the people whose assets rise faster than those prices. Which side you end up on won't be decided by the Fed. It'll be decided by what you do next.